It really is historic. This was something only whispered in the darkest corners of the energy market. Nobody ever thought that this could transpire.
It's all about energy this episode. How much higher can oil prices go with geopolitical tensions in the Middle East?
My fear is this one is different. You will have a persistent political risk premium in the oil price.
We've got Eric Nuttall to break it down for us. The billion-dollar fund manager is bullish oil, but runs a concentrated portfolio of just 10 stocks. And he tells us which ones made the cut. You bought some Strathcona.
Adam Waters and I, we sparred last year. I texted him and said, hey, we're on the same team now.
Why then are energy stocks selling off when the price of crude is spiking higher? Did your thesis play out too quickly? This is a sector that made new highs recently. Hadn't done that since when?
In 20 years.
Looked even younger, if our viewers can believe that. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Canadian Natural Resources and Tamarack, both stocks I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We are doing our swag giveaway all month. I've got the market cap cap. I've got the liquid assets mug. It's super easy. If you want it, all you have to do is be a subscriber and comment wherever you're listening. Any platform, we read it all. We absolutely love it. And each episode, we are going to be selecting a winner. We'll ship the goods out. So it really could not be easier. I'm going to take the hat off now as I introduce the show. Markets are trying to figure out what conflict in the Middle East, specifically Iran, means for the global economy, means for global equities, and specifically what it means for the energy sector. Unsurprisingly, as we've got a major oil producer in Iran effectively knocked out, other oil producers in the region shutting in production because the conflict is spreading, as well as the fact a key channel for exporting these goods, the Strait of Hormuz, effectively shut down, we've seen a spike up in oil prices. What's interesting is that we haven't seen the same spike up in energy stocks, really on both sides of the border. Now, to understand why that is, we've got Eric Nuttall. He's one of the top energy investors in this country. He goes through why he thinks this geopolitical event is unlike others in the past, where the market just kind of digests it and then moves on. But he also says he's bullish on the energy sector, but he's not kind of buying indiscriminately. He runs a really concentrated portfolio of just 10 stocks. So the bar is high to get into the portfolio, and we stress test a bunch of ideas on what passes muster. And maybe a bit of a surprise to investors, he added to a new name. Maybe I'll give it away. Should I give it away now? No, producer Jillian says not to give it away now, but it might surprise you because he was on the other side of that stock last year when it came to an M&A deal. And now it's one of his latest buys in a market that he said in some areas definitely is looking expensive. So with that tease in mind, let's get into it. Eric Nuttall, thank you so much for joining me on the podcast.
Great to be here.
A three-peat. We don't have very many guests who have been on for 3 times. So Thank you so much for joining us for a 3rd time. It's an emergency session.
Yes.
We booked you kind of last minute because of everything that's going on geopolitically and how that is affecting the energy markets. Now that we're a couple days removed from the initial attack in Iran and the wider conflict that is spreading within the Middle East, and it's still raging on as of right now. What are your thoughts on the implications for the oil market?
It really is historic. So I have to do the proviso. It's fluid, it's dynamic, all that such. But if you had told me like the shutting in, and it is shut in, the Strait of Hormuz, like you've got 19 million barrels per day of oil and product moving through there, used to moving through there every day. If you had told, like this was something only whispered in the darkest corners of the energy market, nobody ever thought that this could transpire. And then you're adding on the world's lost 20% of global LNG supply. And they just went force majeure. And there was a headline this morning saying it will take a full month to ramp up to full capacity. This is crazy. And so you're seeing a massive level of complacency in the market right now. And as an investor, you never want this. You never want geopolitics because the equities never fully discount the spike, nor should they. But it's really muddying the waters. Like we turned more bullish on oil around January of this year for other reasons, which I'm sure we'll touch on. This is additive to it. So we're not bullish energy stocks because of what's going on. But when you think about how does this end? Like unless there's decisive regime change, which is not viewed to be likely, our best intelligence is Iran has another month worth of missiles, many months of drones. This campaign by the president announced recently to have U.S. Navy escort ships and such and provide insurance. The best people we have to contact are very, very skeptical of how effective that would be or will be to incentivize ships to move because there's still a safety aspect. It's not just monetary. And so you think about, well, around like 20 million barrels in interrupted oil product, et cetera. Volume is now down 88%. So that I'm going to call that shutdown. Let's just say we even just get back to only 25% shutdown. That's 5 million barrels per day. And so that is completely irreplaceable. You know, even if we do an emergency SPR release, we've seen that in recent history from the U.S.
Strategic Petroleum Reserve out of the U.S., yeah.
That's capped at 1 million barrels per day. If you have a release of OPEC spare capacity, well, that's kind of reliant on ships and tankers to get that out. And so the world's never seen this. And I think investors, the market, the oil market, are using prior playbooks from, the oil spike when Russia invaded Ukraine. We were supposed to lose all this production, never did. When Iran struck the Abqaiq facility in Saudi back in 2019, we lost 8 million barrels per day overnight for a short period of time. But every spike lasted a few days, a few weeks, and then it sold off. My fear is this one is different in that you will have a persistent political risk premium in the oil price, even if things get resolved, because unless, again, there's a decisive regime change within Iran, and many people are skeptical. Like, sure, the supreme leader's gone, but the leadership structure, I am told, was set up to allow the continuation of what we're seeing today. So that's my fear, that you'll have an ongoing political risk premium in an oil price where the fundamentals this year were already set to meaningfully improve.
Now, what about this idea that U.S. President Donald Trump doesn't want that? And that even if there isn't decisive regime change, maybe that doesn't matter for him. His idea of a win can be whatever his idea of a win is. Domestically, he needs lower energy prices. And so, whatever that looks like, that's ultimately what matters at home for his politics.
100%. So you've got a midterm election. Affordability is the number one issue. This is not a popular, the polls I think showed like less than 50% of Americans support the campaign. Once you impact the gasoline price, that number is going to be going down. So that there is a line of thinking to say, this is not going to be a long-term issue. But again, depends on what whoever's controlling Iran right now and what they want to achieve. And even if things seem to settle, I do think you'll get a persistent political risk premium in the oil price. But again, as an investor, you don't want this. You don't want any of this.
The last time we had a geopolitical shock like this was when Russia invaded Ukraine in 2022. You had oil prices move in the span of months from $73 per barrel to $120. Sounds like you're saying this is much sharper, severe, less prepared for. What does that mean for where oil prices go?
Very. So I think many market observers are surprised at the lack of price response in oil to what we've lost. Because again, we've lost, this is by far, this is something that was never expected, I would say. People have thought the idea, but never thinking that it would actually transpire, and here it is. So my core base, so I think as an investor, you've got to have your base case and then the two ends of the books, the bookends, what could be both bullish and bearish. So my base case is this resolves itself in the next week to 2 weeks, but then you've got ongoing uncertainty and you've got an embedded risk, political risk premium in the oil price. Maybe we sell off, I'll reference WTI, we're roughly 73, 74, depending on the moment. Maybe we sell off into the high 60s. That's possible. That would be my base case. To the more bearish side, we were trading at 60 before any of this transpired, because I think people were realizing that the concerns of 2025, what I've coined the most anticipated oil supply glut in history, that was not coming to pass. It was a lot of spreadsheet barrels that people had builds, but in reality, we were not seeing it. Before this incident, global oil inventories, which is kind of our measurement, were flat. We were supposed to be building by over 4 million barrels per day. So that whole notion was busted already. So yeah, maybe we fall down to 60, stocks sell off 5, maybe 10%, sure. That's my bearish scenario. My bullish scenario is this continues. You've already lost 1.5 million barrels per day of production in Iraq because they're running out of storage capability. If you run out of storage and it's full and you have no ships, you've got to shut in. So we could lose another couple million barrels per day on top of that. There were storylines that both the UAE and Saudi are also approaching storage capacity issues. So now we're talking about losing many, many millions of barrels per day of actual production with an ongoing challenge of moving ships. So that's a scenario where the price of all barrels are set off that one marginal barrel. And we're talking, I think that's all-time high oil price, which again is not something we want. It's bad for demand, it's bad for the narrative. You don't get the full read-through in stocks as you would expect. But that's not a 0% probability as of right now.
Why then are energy stocks selling off when the price of crude is spiking higher and there's a real risk that supply could even be more constrained?
I think it's, again, people are using the playbook of Russia-Ukraine, the playbook of AppKick in 2019, where stocks did spike. People were buying into the fear, and it was not a profitable experience for them. But what's unique now is you've got the geopolitical situation. You have already an improvement in fundamentals for oil itself. Demand is record highs. You've got U.S. shale production, which is now declining. We think plateaued to decline. You've got OPEC spare capacity very thin. You've got non-OPEC production, we think, peaking this year. So that was already suggestive of an oil price where we trade already. If you look at historical relationships between inventory and price, we were already heavily discounted where oil should have been. So there's an argument to say that what we're seeing today from the geopolitics is just repriced oil to more closer to fair value. The last thing for stocks, which complicates it, is we've seen a huge sector rotation due to AI fears out of the obsolescence trade into hard assets. So like gold, base metals, energy. We were seeing that already. For my fund, we've been getting redeemed daily for 3 years. That changed as of about a month ago. So we're starting to see flows come in. So we see it from fund flows as well. So as an energy investor, it's tricky right now. What do you do? How should you be invested? Should you be, taking your gains because we've had a pretty good year? And I think as an investor, my core belief is this is a multi-year bull market for energy stocks. And I think I've been proven to be accurate in that so far. We've had a good year this year. We had a great year last year, et cetera. Anybody that bought in the past 5 years have done spectacularly well. I would try my best to ignore the day-to-day volatility. Maybe not turn off the podcast.
Don't turn off the podcast. Turn off the screen at least. Don't do anything about it, maybe.
Just sit on your hands. Yeah. And so long as if you can eat a 5 or 10% short-term correction, believing that you can make significant gains over the next several years, just kind of ride through it. Because I'm armed with the very best data you can buy, literally. I've got satellite imaging. I've got political consultants all around the world. I've got everything, and I'm finding it tough. So to be an armchair quarterback just using maybe Twitter or whatever information source, thinking that you can time it, I think is very dangerous. Because if you sell now and stocks continue to work well, my fear is you're going to miss out what I think is coming over the next several years. And
one of those points of contact that you have, you told me you were just in Saudi Arabia a couple of weeks ago. And Saudi Arabia in many ways kind of controls what happens there in terms of production and their ability to offset maybe some of the production lost. I mean, was this even contemplated a couple of weeks ago? Did you get a sense that there were even preparations underway for this kind of scenario?
I don't think, and it's become public now, that I don't think key leadership within the Middle East ever thought that Iran would strike out against its regional neighbors. There was an enormous amount of back channeling to try to ensure that if something happened, that their partners would be spared, because the infrastructure, key infrastructure within many of those countries is very vulnerable. Like literally you've got multi, like 100,000 kilometer long pipelines that, as somebody suggested, you can go buy a power drill from a hardware store. That's the vulnerability. So it's not just cruise missiles and it's not just drones, et cetera. So I think that's what makes this different, is that Iran is striking out against even Oman, who is trying to negotiate, Qatar.
Neutral, yeah.
So it feels, and I know we've all become geopolitical experts over the past couple of days, but my sense is this is different. It's not core to my investment thesis. It's not the reason why we've been adding, in fact, to oil positions in key names. But I do believe that there's too much complacency right now, and complacency, I think, is creating opportunity.
Now, talk to me about that thesis. We walk into 2026. I think supply glut concerns are still overhanging us. And I remember talking to you last year. You like the natural gas story a little bit more than the oil story. Obviously, that tune shifted as 2025 played out. So you walk into 2026 and you're bullish oil again.
Yes.
You remain bullish.
Yeah.
Tell me why.
Yeah. So about a year ago, I would have said, well, it came back from Riyadh. OPEC plus agreement was decided to be unwound. There was going to be a return of volumes. And spreadsheet math would have suggested that global oil inventories would climb to their highest levels in history, massively dwarfing even the glut during COVID, during the biggest demand shock in history. And so that was wide consensus. What we've seen since then, we've monitored it very, very closely. We started to get a little more incrementally positive in the fall time, because the ads, you just were not seeing them by the magnitude. We attended a key conference in London in October, I think it was September, October, whatever, came back even further incrementally bullish. And we thought that given the level of pessimism, there was some pretty good opportunity. So I'd say between the fall of last year and January of this year, a few things were obvious. Demand was exceeding bearish expectations. What we've been waiting for, I would say we were early, we've been a large proponent of the idea that U.S. shale production is reached its twilight. And as a reminder of why that's important, U.S. shale production has been 118% of total growth in non-OPEC producers over the past 15 years. So 118%. How is that possible? It's because other countries are in decline, generally speaking. There's 79 countries within non-OPEC that produce oil. 74 of them are in permanent decline. Canada is an exception to that. So you've got, we're getting through the glut. It's not happening. Demand is exceeding bearish expectations. U.S. shale production, we can see it in real time. What we've been calling for is happening in real time. It's now, we think, reached its plateau. We don't think a decline, more like a plateau. So our belief was, as investors look through first half of 2026 beyond to the second half of 2026, what do we have? We've got peak non-OPEC production. That's 68% of global oil supply. We've got OPEC, which has been normalizing their spare capacity. We think it's way less than consensus. We think roughly 1.5 million barrels per day. That even may be slightly high. So you fast forward a year from now, demand grows another million. You've got no production growth from non-OPEC by this time. It'll be flat exit to exit, 2026 over 2025. And OPEC, well, if they've only 1.5 million and you reduce that by 1 million to satisfy demand, where does the next year of demand growth come from? And that, I think, in that question is the ability to make generational wealth.
Did your thesis play out too quickly? And I ask that because this is a sector that made new highs recently, hadn't done that since when 2008.
Sometime, 20 years.
Time.
20 years.
Yeah. You looked even younger, if you can, if our viewers can believe that.
Yeah.
And I see a lot of complaints, a lot of chatter about valuation. I see downgrades on valuation every day in the energy sector. And what do you think about that?
Oil stocks did better than we expected. And I think part of that was it was a massively out of favor, massively underweight sector. And you've had this rotation out of other sectors. Like I was told all of last year, oh my God, well, you're underperforming NVIDIA. So like, why would we buy your fund, right? And it's like, well, it's not quite the comp, and there's benefits of diversification, all these other things. But I think you've got, 26, 28% of the S&P 500 now chasing less than 5%. Like hard assets, materials, energy is 5-ish% of the S&P 500. So it's a lot of cash, a lot of waiting, trying to reweight into other areas where you don't have this AI threat, and that's just the topical of the day. So it is a challenge if you were to have been using $60 oil. The valuations of the generals, the large cap names which people flock to, they're easy to buy. No one's ever gotten fired owning Canadian Natural Resources, for example. It's really expensive. We've been adding to other names, and that's the benefit of hiring a guy to do this for you. So my job is to scour the market and find, okay, where are those opportunities where I don't have to buy into, the Eric Nuttall thesis of multi-year bull market for oil, and we're going to see all-time highs, all that stuff. Set that aside. Use strip. Use where we were a week ago. And can you get excited about the valuation? Can you see upside in names? And there remain a lot of names where we see meaningful upside, but it just may not be, it's not in the low-hanging fruit anymore. The super easy money using, maybe not today's oil price, but where we were a week ago, that easy money's been made. It's now you've got to do a little bit more work to find names to make significant gains in.
Well, and I'll toot your horn for you, but you're outperforming over the past year, the oil producing index on the TSX, and you've kept up with NVIDIA over the past year.
Yeah, we are now.
So now that energy has come back. Now, I think you let slip that you were buying on Monday and you bought some Strathcona. I don't know how much you want to talk about that, but that's a stock that maybe didn't participate as much in the rally. And so was that, if you're calling like CNQ very expensive, is that part of we're hunting right now? Why did Strathcona screen as attractive?
It does.
Especially after all the stuff that went down last year.
Yeah. So our process over the past couple of weeks has been you core up, use the rally, any names that you are not like in love with, unless you've got a really, really powerful thesis around, sell, take profits. And we realized a lot of gains. Take those proceeds, either sit in cash or redeploy into really the core of the core names. So we're only sitting on 10 names right now. We'd have roughly 16% cash.
How unusual is that for you?
We do typically have 14 to 16. 10 that's tight.
Okay.
Because the names, so my core thesis is the narrative about this super-glut has been laid to waste. Not laid to waste, but it's been proven to be inaccurate. The level of bearishness is not warranted. And if you truly believe that demand for oil will grow out to 2050, as even the IEA says now, if you truly believe what your eyes will tell you, that U.S. shale production has plateaued, and as a consequence, non-OPEC production has peaked or is peaking, and we feel pretty good that OPEC spare capacity is a lot less than people believe, that is suggestive of meaningful higher oil prices. So you can try to be cute and time that, or because we manage about $1.5 billion now, you got to get positioned before the herd comes. And so we've been pretty good at finding opportunities where there's liquidity available. Strathcona has always been on our list, and Adam Waterson and I, we sparred last year, and that's fine. I texted him and said, hey, we're on the same team now, and hopefully this long-term position, we're going to together see $100 oil again. And he replied. So it's a name where it was off the radar screen. There are, why does not everybody own it? Well, there's liquidity challenges, right? There's concentration.
How did you get liquidity?
You find liquidity. So we have partners on the street. We're a very good client. People know where to reach. And so we found somebody to buy $120 million-ish worth. We're up like 10 million in a week or so. So you find liquidity.
That's a big deal for people who don't know, because that's a hard stock to do that.
But we've been like Athabasca, finding liquidity to get in, finding liquidity to get out when the stock's gone up 20x and it's a big position. So it's not on the radar screen of everybody. Mm-hmm. We're paying a half the multiple of a C&Q. we're getting even better reserve life longevity. And again, if you believe that there's a structural mismatch between supply and demand coming in the not so distant future, the value of long-dated reserves, I think, is going to go up meaningfully. So where do you find those reserves? Well, we already had a huge weight in core names, like this is all public, Athabasca, Whitecap, Tamarack. They all have 20 plus years of at least of stay flat inventory. We've got a big position in Cenovus. So where do you go? Well, here's an opportunity to take a 9% weight in a name trading at meaningful discount because of reasons where maybe there was an overhang. We helped take care of that overhang. So yeah, we're happy with that so far.
Do you think Strathcona plays in M&A in general in 2026? Yeah. I think that's still a thesis people expect to happen. I mean, if anybody missed the backstory, it was Strathcona trying to buy MEG. Yeah. Ultimately, Cenovus bought MEG, and Strathcona walked away with a nice chunk of property.
Yes.
To basically go away.
I think the opportunity for mass M&A is over. I don't think there's a lot of super attractive opportunities available, but for Strathcona to be successful as a company and a stock, given how much inventory they have in their existing growth plans, like they're going to grow by 50% over the next 5 years, you don't need to backfill that. And so they have one of the largest standing inventories of any company. Sure, maybe the average quality of that is not, similar to a Cenovus, but if you're bullish on oil, we've done exceedingly well finding companies with kind of tier 2-ish assets where maybe the costs are higher or for whatever reasons, where the benefit of that next incremental dollar in the oil price disproportionately is enjoyed by a company like a Strathcona than it is a name like a Cenovus. Like Athabasca, how do we make massive score on that? Well, oil was at 54. They could barely keep the lights on. We just thought oil would go to 60 at the time. Mm-hmm. And their free cash flow would go up by 10 times. That's what you're looking for. And that's what I think we're getting in a name like Strathcona.
I want to go into the mailbag. You mentioned Adam Waterous. He talks a lot, not just obviously about Strathcona's ambitions, but he talks a lot about the energy sector's role in building Canada's ambitions. And I thought it was really interesting. I saw you and I listened to your testimony, if we can call it, in front of the Canadian government. Which committee was it? It was
the Standing Committee of Natural Resources on the Need for Energy Experts or something. It was a big mouthful.
Okay, well, you're the guy to call like for whatever that title is.
Yeah.
And you gave a really passionate defense of the energy sector, but also kind of offered it up as a sector that could cure a lot of Canada's ills. I'm so curious, A, how that came about, because it's not every day that you get a money manager up on the Hill talking about a sector like that. And B, what the feedback had been, either from your peers or from politicians.
The feedback's been very positive. We're very happy with how it went. It was great to have the opportunity in that format to be able to speak directly to the guys making the decisions. I think, off camera versus on camera are two very different things. I had a good, little conversation with a gentleman from the Bloc Québécois. I would say the reaction I got from Liberals off camera were quite positive. Mm-hmm. I do think you've seen a significant narrative shift from the Liberal government under Carney's leadership versus the old guy who just didn't get it, where they just understand just how critically important energy is to the Canadian economy in terms of being able to lift us out of this situation where we should have better streets, we should have more doctors, we should have better schools and all of these things. And it is such an obvious path that we should be taking. And it was frustrating to have to explain that to some of them that I don't know if they still get it, but it was good. So feedback's been very positive.
Is it enough? Based on what you see, I mean, you were rooting for Poilievre. I know that. You were vocal about that. But now, as you said, it is a shift definitely in tone from Mark Carney, but still no real action.
To be determined, right? There's this grand bargain. I've called it the grand ransom with Premier Smith. I think the notion, like the world's changed. This whole net zero by 2050 is dead. Only the European Union and Canada are hanging on to that notion. Every other country is pivoting away from it because they're realizing that it leads to energy scarcity and energy unaffordability. And politicians are literally getting fired in real time from that. You look at what happened in Germany. So to require industry to spend $24 billion on carbon capture to allow us to potentially get a 1 million barrel per day pipeline if a private company is willing to step up and spend 35 to 40 billion on that, which I do not see happening, is that going to transpire and, result in anything? Not likely. Do we need it? It'd be nice. We should. Like, as I mentioned, the math that I did was 1 million barrel per day pipeline would generate enough royalties to pay for enough doctors for 17 million Canadians to get healthcare. It's insane. Like, it's the biggest no-brainer of all time. Will we get it? This is Canada, so it's 50-50 or less. But what I think we have are companies have already announced expansion projects. There was even another one that was put forward this week in the United States to try to connect to Keystone XL infrastructure. So just in aggregate, those all actually amount to over 1 million barrels per day of new capacity. Great for Canada. But again, in a world where demand's growing by 1 million barrels per day or more per year, and 68% of production in non-OPEC can't satisfy it, and OPEC after 2 years can't satisfy it, we should be doing more. And there's going to be a huge opportunity for any country that can step up and add barrels onto the market.
All right, so TBD on that for Canada. Yeah. Let's get into the mailbag because everybody wants to know what you think about some stocks.
Sure.
Okay, it would not be an Eric Nuttall podcast if we didn't start with Baytex.
Of course.
People are not going to let you live that down.
Yeah.
This question is actually from Modern Jazz 2 on X. But we got a bunch of questions on Baytex. The question is on Tamarack Valley and Baytex, which I think we can take separately. We had a lot of questions on Baytex and whether you regret selling it, because shortly after you sold it, I believe, or revealed that you sold it, the stock started to rally again. So
I'm trying to remember the timeline. I don't remember where we sold it.
January
of 2025.
2025, you sold it.
Probably in the high threes.
I think maybe
Something
at a
like,
profit
low
for
fours,
yourself.
whatever.
Yeah.
Sure. Well, you don't get everyone right. Baytex as it stands today, it's done quite well. It's trading 520, 530. They're just reported. Key to that story is they ditched the Eagle Ford, which I think, they would admit probably was a mistake. It probably didn't live up to what they were hoping for from
buying it was a mistake. No.
Correct.
Yeah.
So now they've repatriated to Canada. They've got a pristine balance sheet, and they're going to use 675 million roughly of that to buy back stock. So that the stock's reacting in anticipation of that. We had a good meeting with them. We don't own it now. We bought in the low to mid fours and it jammed up. We made 15% in a day or something. So it's okay, we move on. It's more of a price sensitive stock for me because in the mid fives, like unless you're really bullish on it, which we are, but it's starting to bake in some of that. It's gone from trading roughly 3 times. It's now 4.5 times. For a mid cap now that's approaching fairish value, the more expensive the stock, the less of it that they can buy back. So you're not getting as much impact from that. Inventory concerns that I had prior to it have been alleviated somewhat. We had a good meeting with management a month ago. It was around Christmas time, give or take. So it's on the radar screen, as several are. I think I would prefer a better entry point than today.
Okay, what about Tamarack Valley, Clearwater play? A lot of excitement.
We're up. I think we're up. We had sold a little, but we're up $70 million on that one. It's been a spectacular, like 150% gain or something.
Too spectacular? You called the CNQ expensive, but is Tamarack?
Oh, it's got long ways to go.
What's the excitement here? Why is it different?
It keeps getting better. The results keep getting better. They keep beating. They put out the reserves. So then what they said is, okay, it cost us $8 to find a barrel, and we're selling that barrel for $55 sales price. And if you strip out costs and royalties and such, they have a 50% margin on that barrel. It's just spectacularly profitable. So they can take that, recycle it back into very modest production growth, but increasingly now buying back stock. So it's a name where, if you look at $60 oil and where they are today, perhaps you'd say it's fairly valued. I think the real money is looking out a few years from now, not having to get too aggressive on the oil price, but we still see very meaningful upside in that.
There's another Clearwater play, Headwater.
Yeah.
Do you own both?
We don't own a Headwater. Headwater trades at about a 1.5 premium to Tamarack. They do have some exploration potential upside, and acreage which they haven't revealed, et cetera. But we chose Tamarack. You could own both. We own Tamarack, and we've done exceedingly well.
Okay, we're going to go a little bit down cap for our next question. This is on Logan Energy. This question coming from Kyle on X. He owns CNQ and ARC, but I've been looking at a junior, Logan Energy. They seem prime for expansion over the next few years. Could you ask Eric if he knows them or if this is the time to play it safe and keep money in the majors?
Yeah. So I see the attractiveness of going down cap. But I would warn people there's a challenge of going too far down cap because you suddenly get to a point where there's no institutional money there to buy the stock, which is helpful to get a name to re-rate and move. Like in the Canadian energy sector, there's basically two energy funds left, me and Dave Shabunka at Canoe. He's a great guy and great competitor, but there's two of us. And the ability to go too far down cap is challenged because we both manage roughly the same amount if you put all funds together. And you can't get into a small cap company because as an individual fund, you can't own more than 9.9% of it. And if you do, then there's liquidity challenges. So I would worry that some stocks could be value traps where you just don't have that buying power. I think it's better and more intelligent to find that sweet spot where, not too big, not too small, big enough where it's got liquidity, it's big enough to attract institutional interest, but it's not so big that everybody owns it and it's fairly priced.
What's a good example of that?
Well, I would say Whitecap.
Okay, we'll talk about that later.
Yeah, if you want to be over $2 billion, roughly, that's one of those, but a general rule of thumb, I'd say $2 to $3 billion as a bare minimum. If you ask most generalist institutional investors, they would probably say $10 billion as their cutoff.
Now, what about this idea? You hear about it in mining a lot. Like if you really like the commodity and if you want super leverage to the commodity price, the juniors it's a higher risk way to play it, but potentially higher reward. It sounds like, do you not see that coming because of the liquidity issues? Like in order for the stocks to move, there needs to be people who can step in and buy.
Yeah, like retail is big buying power. It's a big force, but why not have both? So if you can find stocks that have as much, if not more upside, like we own some mid caps, which we think are doubles from here. If, the stars align and certain things transpire. Like why take on the risk? And I can't go into, I got an email from, we've got 26 million shares available. It's $1 stock or something, like $26 million. Okay, well, that's like less than 1% weight kind of thing. Like it's not moving the needle. Why bother kind of thing? Like I'm a big fan of concentration of power, concentration of focus. Know fewer names better than anybody else on the planet, or at least try to. And that's where you can really make serious money.
Well, let's go to one of those names that you know really well, Cenovus. We have a question from Michael on that. What is your thesis on Cenovus? Obviously, it bought and is digesting the mega assets. It's also one of those stocks that have run up with crude prices. Now that all the drama is over with the takeover, what's the path forward for Cenovus?
So the thesis was here you have an exceptional suite of oil sand assets combined with mediocre refining assets and a management team that was strongly incentivized to get the refineries working properly. And they'd communicated it's going to take time. What we're seeing is they've righted the ship. And there was a huge re-rate potential in that stock to get closer to a Suncor or CNQ multiple if they were to do that. We started buying it aggressively in the 17s, 18s. This would have been fallish of last year. We completed our position around 23-ish, and now it's 31. So I would say the thesis of that multiple re-rate is starting to come to pass. They still would trade at about a 1.5 multiple turn discount to Suncor with similarly quality, if not better quality assets, at least in the upstream assets. And it would trade at a 3-turn discount to CNQ.
You bought additional shares of Cenovus.
Yeah, we're maxed out. It's like a 10% weight.
Okay, but I imagine your MEG position would have rolled into Cenovus, or did you not take it that way?
We had sold the MEG. We sold the MEG, and then we bought Cenovus clean.
I see. Okay. We've got some questions on the nat gas space. Eric, as the energy superhero, what's your take on Birchcliff? This coming from Sachin on X.
Yeah. So our preference remains U.S. versus Canada for natural gas exposure. part of the reason for that I would say is starting to falter, and it's the reason why we've reduced our natural gas weight in the fund very recently. And that is U.S. producers were always showing better discipline, meaning they weren't chasing the price, adding volumes, et cetera. So supply wasn't as responsive to price. You're seeing that shift a little. Like there's the bane of our existence in oil shale for several years where you'd have a couple private companies, so PE backed, and their business model was to blast through all of their inventory in like 2 years, jam up production, and then sell that. And it kind of deferred the inevitable, the inevitable plateau in U.S. shale, which we now have. We're seeing the same thing happen in natural gas now, where there's one private company in the Haynesville just blasting through their inventory, hoping to sell to somebody. So it's that's annoying. Plus, there's a couple public companies that are starting to tilt a little. Well, we could grow here, we could grow there if AI demand and data center demand. So natural gas, like we would have said, the marginal cost of supply is $4. That may be coming down a little. Then you get to Canada. Okay, we're at the end of the pipe. We have had, LNG Canada, which is great, but supply completely front ran that. We're going to go from about 2 BCF a day, billion cubic feet a day of exports today to about 6, but that's going to be 2031, 2032. And we're just so good here. We have such good rock that I just saw like well results on the weekend. Companies were drilling 40 million cubic feet a day wells. When I started 24-ish years ago, companies were drilling wells that were coming on at 0.15 million cubic feet. Like it's just insane, right? So we've got all the supply. I'm really challenged to see meaningful upside in the gas price versus for oil, geopolitics aside, I think we're going back to all-time highs in the next several years. So that's why we've wanted to shift less out of gas than oil. So Birchcliff, do you want Canadian exposure in a company that has good rock, but they're growing into the supposed, bullish outlook on gas? That's not our style. So it's not a name we own.
I assume then that as a follow-up, we've got a question from Joe on X that ARC Resources would fall into that same category.
No, they are gas, but it's more of a condensate story when you look at the revenue mix. They've clearly stubbed their toe with Hitachi. It's a name we did sell, right, maybe slightly lower than where it trades now, with the belief that it would be dead money because they communicated and they're transparent, but it's going to take 6-ish months for them to figure out what's going on. Because as of even right now, I'm not confident that they know what exactly is going on.
The backstory is they've got this Hitachi asset that is supposed to be their next leg of growth, and they've had to delay when that growth shows up because it's not going according to plan.
It was the core to their growth of liquids. So if you defer Hitachi, they'll milk the free cash flow of what they've already spent. All of their growth is more natural gas, Canadian natural gas. That's not always, I don't think is necessarily a good thing. I'm more optimistic on the liquids. So that was really the underpinning to the growth thesis of the company. And they were very confident. It was well delineated. And then sure enough, they get well results for different reasons to bore people, but they're just not coming in on what they thought they would be. And when a technical team doesn't know what's going on, how can an investor know what's going on? So it's just in situations like that, it's usually best just to move on, keep it on your radar screen. My partner is a geologist. We're looking at well results in real time. I just don't feel like now is the time that we have to own that stock.
Yeah, because we had a guest on who said, what do I care as a long-term investor if the growth shows up in 3 months or if it shows up in 6 months? Like if you just have confidence that the growth will show up at some point, the technical team is going to get it right and they're going to figure it out. Or do you think that's too much of a risk? You think there's a risk they don't?
Maybe they do, maybe they don't. They think they will, but they haven't so far. So I hope they do. I love, they're great guys and I'm cheering for them. But when you give me $1 today, where am I going to invest it? I have other more attractive things where I can make shorter term money. If you have a 10-year time horizon and you don't care, then sure, that's likely an opportunity, but there's just better opportunities right now.
We got a question, again, a little bit smaller cap, but bigger than Logan, Surge Energy. Do you like Surge Energy? It's got a 6.3% dividend yield, or is the company too small for you to take a position in? This question coming from Gord.
The stock's done nothing for like 15 years.
But then it woke up.
Did it? Really? Pull up at 15?
No, not 15 years. I'm talking about in the last year.
Okay, sure. Great. That's wonderful. It's cheap. Okay, it's always been cheap. It will always remain cheap. Paul Colburn is a very lovely man. they've done a good job of drilling, good wells, it will never be institutionally palatable, and it inevitably will sell themselves at some day.
Wow, that's so severe, Eric.
I speak
never institutionally palatable.
I speak the truth.
Why?
It never has been.
Okay. And who would want to buy it then? Can you not buy it for that, a potential takeout?
You never buy a stock on a potential takeout.
Tell me why.
Even MAG. I never own MAG for a potential takeout. I never own Nuvista on a potential takeout. Because if that's your investment thesis, timing that and nailing the price and getting over board entrenchment and finding, somebody willing to buy a company at a price you think is attractive and all these different things, it's hugely challenging. So again, there's a lot of opportunities out there. Why choose such a narrow niche of an investment thesis? I'd rather buy a really great team that I like, really great rock, really great assets, pay a reasonable multiple where they're just going to milk it for free cash flow and buy back half their stock over the next 5 years and the stock's going to double. You can do that, or you can buy another name which has done nothing forever, despite good efforts on their part. Mm-hmm. Which one would you choose?
Okay, well, this is a nice segue actually into your pro picks because I believe 3 of the 6 past ideas have been taken out. ProPicks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so because you've been on twice, we have 6 ideas to kind of compare. You were on in January of last year and May 1st of last year, and 3 of the names have been taken out. Varen, upside 17%, taken out. MEG Energy, upside 30%, taken out. And again, your prices might be different, but this is just from when you recommended it. And Nuvista, taken out.
I'm sad.
And I feel like you don't like that.
I don't.
Tell me why.
We're in it for the long game. Like you've had Cole Schmid on. We've disagreed over this. Like I don't want to trip over pennies on my way to dollars. And I'm not buying companies with issues that need to be fixed. And if people were just to be a little more patient, I think we would have made significantly more. Like imagine MEG today in a standalone basis at $75 WTI and $12, $13 WCA diffs at a time when there's scarcity for long life reserves. Where would that stock be? It'd be way more than what Cenovus has performed. So it's an example where I'm not hoping for any of my names to be taken out. In fact, I don't want them to be. I want my investors are very patient. I'm very patient. I want to let the thesis play out.
Your remaining 3, Athabasca, Expand Energy, and ARC Resources. Athabasca we're going to talk about because you've brought it to us as a top idea once again. ARC, you've already said you've moved on because of their Attachie woes. Expand. I think a lot of people have questions about that. That one's about flat from when you talked about it in May. Do you continue to like it? Has the thesis played out? Is it slower than you expected?
It's the largest natural gas producer in North America. What was different to us is they jettisoned their CEO. In fact, I met the interim CEO yesterday. So he was in Toronto. So the core thesis has not changed. But when you don't have a permanent CEO, it's difficult to attract capital because investors say, well, okay, we'll just wait for the new guy, which is going to take 4, 5, 6 months and see what he has to say. So it's probably not a name that we would be deploying new capital in, especially.
You're hanging on?
We're not. Yeah, we're more biased towards oil than we are natural gas.
Okay. So with that in mind, you've brought us 3 oil plays. Whitecap is one of them. And we actually got a lot of questions in the mailbag about Whitecap. So talk to me about your thesis here. Again, you only own 10 stocks right now.
Right now, yes.
Right now. So that means that you really had to scrutinize these names for them to qualify in the portfolio. Why did Whitecap make the cut?
Yeah, it remains our largest holding right now. It's built roughly 11.5% weight in the fund. And it checks off every box. You have a CEO who's been in the game for a long time. I would expect him to retire in a couple of years. Honestly, he's done a great job. He's very reliable. They've beaten, I think, for like 16 quarters or something in a row. It's ridiculous. They stole Varen from us. at a great price for them. They've got 25 plus years of stay flat, tier one, super high quality inventory. They've got a market cap that is big enough to be relevant to institutional investors. I'm going to use my cheat sheet here, but like $16.5 billion market cap, that's big enough for anybody to want to buy. And yet it trades at a discount to their larger peers. Like we would have it about 5.5 times, where you're paying closer to 8.
Why does it trade at a discount?
Well, it takes time. It takes people are so slow. Like I find generally like we're pretty fast, but it just takes people, they need to meet them multiple times and get bullish on energy and get bullish on oil and okay, we'll dip our toe. It just takes time.
Move beyond CNQ and Suncor.
Oh my God. Yeah. Maybe we'll take on some risk and we'll get out of CNQ a little and dip our toe. And so you don't need much though for these names to re-rate. So for us, like, if I'm paying 5.5 times, that'd be using 65. So it's closer to where we trade now at 75. It's trading at 4 times. Well, okay, we're not going to use current spot for that. But we're bullish on oil the next several years. So what we have a stock where, let's use 70, look out a year from now, and this is contingent on multiple re-rate, on them continuing to execute, continuing to drill amazing wells, no more M&A, all this different things. A 7 multiple for us at $70 oil is a $20.54 target price. That's 51% upside. And we're significantly more bullish on oil over the next several years. Because again, demand's growing, supply is not. Oil has to respond high enough to incentivize high risk offshore exploration and development. That's not happening at 60. It's not happening at 70. I don't even know if it happens at 80.
And at a time where we were talking about expensive stocks in the energy sector, you're looking at Whitecap and saying it's trading at a discount.
Very.
Despite good execution.
And it's only up 19% this year and it's lagging others. So I've got everything I need in a name trading at a discount to its peers, pays a 5.4% dividend. It's got a great balance sheet. Every single box I need to check off, it has.
Okay, so that brings us to Athabasca, which has actually been, a home run for you. It's up 64% from when you last recommended it. We actually got a question about this too from Michael on X, who wanted to know about the potential for a dividend. Talk to us about Athabasca. Do you think a dividend at all is possible for this?
I don't think it's their highest priority. You've got a massive reserve base, which I think they want to grow into a very bullish backdrop eventually once the oil price is higher sustainably to justify it. So it's a name where it's an interesting example. If you looked at you pull up a stock graph, you'd be like, oh my, we got to sell this thing, right?
Because it's so beautiful.
It's done so well. It's spectacular. It's like it should be in the Louvre. It's unbelievable. But it's a name where, because of the gift that so many of these Canadians have, such deep reserves, it's really important to look out beyond the here now over the next couple of years to see, okay, well, what could it be trading at in 2 years, 3 years, 4 years from now? Because that's really, one, it will give you staying power to sit on your hands and not take short-term gains, and you'll realize a lot more of the win. So for this name, just keeping production flat, the oil price flat at $70 oil. So a discount to where we trade today, well below what I think is the marginal cost of supply. Just through modest growth and ongoing share buybacks, they'll compress their multiple from about 7.5 times today to about 5 in about 3 years' time. So it's a name where you don't need the oil price to continue to go up for a company like this to do very, very well.
It's one of those names I said that, there's a bunch of downgrades in the sector. Most of them are valuation.
Sure.
Athabasca got a downgrade at the end of February. Love the company, growth prospects, everything's awesome. Price target goes up, but it got downgraded on valuation. What do you say to that?
I don't listen. We have our own price targets. I never listen to Bay Street analysts, and they're all good people, but their priority number one is job preservation. And many of them have been far too bearish on the sector and far too bearish on the oil price. And a lot of them just use strip. So it's like, okay, strip falls and then strip's 57, therefore it's a sell. Well, you got to have a call on the commodity to begin with. You've got to have a call on looking beyond the next 6 months, look out to realize the full potential in a name like this. Like we've ridden this name from 17 cents. We would have been in and out a couple times, but we've gone from 17 cents to $9. If I had listened to Bay Street analysts from that time, we would have sold many, 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 many dollars ago.
Is it?
In fact, when I bought it, it was probably a sell at the time.
Yeah, universally
rated.
A sell. Yeah. Is it a I know you don't like takeouts, but it's a small size. It's doing well. Do you think it's on the radar of other producers?
I think if I'm directionally accurate in the world that we're heading into, there is going to be a crunch, and the strategic value of long-dated reserves is going to go up meaningfully. And so we're aggregating resource now in anticipation of that coming I'm not going to give a timeline, but in the future, because we have to be positioned for that. And so there's names where I just want to sit on my hands and not sell anymore, despite short-term runs. Maybe we get a 5% check back. Great, like big deal. This is one of those names. This, Strathcona, a couple others, where I think the strategic value of what they own is going to be resultant in a meaningfully higher share price, or we wake up to what we've done with Varen and Nuvista and Meg, et cetera, where if the market doesn't realize it, then an acquirer, especially at a time when booked reserves globally are at their lowest levels in history, literally, at a time when oil demand is at its highest point in history, at a time when non-OPEC production is peaking, at a time when OPEC spare capacity is near a record low. So that's the world that we see. And I don't think we're going to be alone in a year or 2 or 3 years' time in recognizing the strategic value of long-dated reserves.
You said you have a price target. Can you tell me what it is? Higher. I thought I could peg you down on that.
Just sit on your hands and let the thesis play out.
Okay. Your third one is Ovintiv, the former Encana. God, all these name changes. What do you do with
this
them?
This is a horrible name too.
Horrible name.
Yeah, horrible.
Did I even say it right? Ovintiv. For a while, I wasn't even saying it right.
Yeah.
The former Encana, did you come through it purchased Nuvista, which you own. Did you come to the name through your ownership of Nuvista?
No, we bought it fresh.
Okay.
So we had sold Nuvista. We wanted to squeeze more upside out, and we was trading what we thought was fair value relative to the bid. We've bought Ovintiv, and it is a new name for us, but it's big weight. It's 9%. We're up 23-24% on it so far. And the thesis is you've always had this stock that is a hedge fund hotel. It's always like high beta. You've got the knife fighters in the U.S. hedge funds, trading it around the quarter. Will they hit their quarter will they miss by a penny, beat by a penny? And that's not our game. We're in it to buy a company that has repositioned their portfolio. They were all in these disparate areas. Now they're in 2. They're in the Permian and they're in the Montney. And they've got really good positions in each. So they've cleaned that up. And in doing so, I think they're becoming more institutionally palatable to get better investors into it and ultimately result in multiple expansion, because there's no knocks anymore. And they just sold off their last non-core area, paid down debt, and got to a point where they're now going to be returning at least 75% of free cash flow back in the form of share buybacks. That's critical. We've really done well in identifying companies that have just reached that threshold, and it's the buybacks can really propel the share price up, and it's starting to do that now. So we look at a company where they'd say they have, at least 20 years of drilling inventory in the Montney. We would say at least 15 in the Permian. So that's quite good. Maybe they even sell the Permian one day and come back to the pure Montney. And let's run with $65 oil. They're trading at 5 times cash flow. So significant discount.
Yeah.
And from a free cash flow perspective this year, we'd have it at about a 10-11% free cash flow yield. So, you put a 6 multiple, run with $70 oil, well, that's 50% upside. And this is a name, again, where every year you're going to get that cumulative impact of share buybacks where they can buy back 10% of their stock
and you think
year
they've
after year.
Cleaned up? They're not as disorganized as they were?
No, all of these skeletons in the closet we think have been revealed. All of the historical knocks against it have been revealed. And I really had to get my head around, okay, is this a value trap hedge fund hotel stock, or does it have the potential to morph into something else, something new? And that's kind of where we've gravitated towards. And the stock's telling us so far that we're right.
Eric, it's been an absolute pleasure. Thank you so much for joining us.
My pleasure.
It's Eric Nuttall joining us of Ninepoint Partners. Don't miss our next episode. We've got Greg Dean of Langdon Equity Partners. He focuses on small caps. If you've got questions, email us at questions@inthemoneypod.com, and we'll see you on the next episode.